This is InvestTalk. Independent thinking, shared success.
This is Rob from Florida, longtime listener. Appreciate everything that you do. I have a quick question on a particular stock, ticker symbol KMI, Kinder Morgan. And I'm interested in probably purchasing this for immediate long term. And I would like to get your opinion on it. Thank you again, and have a great day.
All right, looking at Kinder Morgan is one of the largest midstream energy firms in the United States. I believe this used to be a limited partnership, but no longer is. So that's the good thing, is that dividend yield, which is right around 4.3%, that's going to be qualified dividends, which used to not be. So that's a positive there. And earnings are expected to be up 11% this year, 6% next year. And its relative strength is around 54. So, kind of middling on its strength over the past year compared to the overall market. And it's been kind of going sideways over the past 6 months or so. What are your thoughts, Luke? What are you seeing in the data?
Well, in terms of revenue growth, it's pretty decent coming out of 2023, right? They hit peak revenue in December of 2022 with $19.554 billion, dropped dramatically to 15.1, projected to be about 16.5 at the end of this year. At the same time, margins have been expanding a bit, though, up from 13% net margin in 2022, projected to be 17.2% this year. So you're seeing strong growth in their fee-based natural gas pipeline volumes, rising EPS as well. And because of that, they really outperformed the industry, though it's kind of not difficult to outperform energy broadly if you aren't an oil name this year. And so they're only outperforming by 1.6%. Year to date, they're down 1.57. Over the past year, up 23.43. And that's all led them to be trading in the upper end of their 5-year range from a relative valuation perspective, looking at forward-looking price to earnings of about 20.5.
Yeah, I think that's my biggest worry here, is that growth is not that great.
Yeah.
And profitability, return on equity is 8.5%, but they have a lot of debt on their balance sheet, which is common for these type of names because it's highly capital intensive, right? Building out those pipelines, maintaining those pipelines, et cetera. But their free cash flow has dipped to about $2.7 billion trailing 12 months from a peak in 2021 around $4.4 billion. So certainly some weakness on that front, and the payout ratio is at 95%. So it's not like there's room for that dividend to go up without them really adding more debt on their balance sheet, which I don't love. I just think there's better opportunities out there. It's okay, but it just doesn't get me juiced up. And then you look at the chart, it's kind of neutral to bearish as well from its all-time high back in, late January. So I don't know. I'm not really getting excited. It's not terrible, but it doesn't excite me. What about you?
Yeah. No, I do tend to agree there. And when you add on with what you mentioned, right, with that slower growth, then it's in the upper end of its 5-year relative valuation. That's where it becomes one of those names where I like the theme and I like the demand for energy and natural gas and nuclear and all of these things over the next 5-10 years. But maybe this isn't the right way to play it.
I agree. Now, we receive questions from the comment section over on the InvestTalk YouTube channel on a regular basis. So let's tackle one of those questions now, Luke. Gary Miller, he's from the Department of Redundancy Department, says can you analyze Ralph Lauren, RL, and share if this is a good time to pick it up? RL is the symbol.
Is it Lauren or Loren?
Well, he spells it Loren, but I'm pretty sure it's Ralph Lauren.
Hopefully we'll come to figure that out during this discussion.
Yep. There you go. So Ralph Lauren is, it's about $17 billion market cap. Earnings supposed to be up about 12% this year, 10% next year. Revenue growth last quarter about 8%. Certainly a strong stock, relative strength at 91. But did he miss the boat here, Luke?
Yeah, it is strong. And one of the reasons why it's strong is comparatively looking at other clothing companies, right? The return on equity here is about 30%. American Eagle, a competitor, is about 12.2%. And that's why it's trading at double the forward-looking earnings, trading about 20.3 times again, on the upper end of that range, just like the last name that we looked at. And this is at a time where you are seeing slowing revenue growth as people start to pare back spending, new clothes being one of those areas where they would do that. Yet again, we see margins are expanding here. We're seeing a pretty consistent share buyback program, down from 75 million shares a couple years ago, down to about 60 million now. Now, one thing to note, though, there's a little bit of short interest out there, nothing too crazy. I think that the reason why this company has done, particularly well, especially compared to its peers, is because of that margin expansion, right? If growth is slowing, but your business is becoming more efficient such that your utilization, your profit from your operations becomes better, the market obviously likes those things. And at the same time, you're seeing the brand grow internationally as well. 20.3 times. No laughing matter in terms of expensive, or rather in terms of cheap, right? That's a pretty high valuation for a clothing company. Did he miss the boat, though? I'm not sure. It seems to be justified given what we've seen of this company in terms of earnings over the past couple quarters.
Yeah, I worry a bit that the profits expansion is more short-lived. Mm-hmm. That's the history of clothing brands, right? You go through periods where you're in style. There's a lot of consumer spending. Consumer balance sheets are strong, and you've seen that as of late. And but styles go in and out. Yeah. And usually when you're old news at some point, and suddenly you probably created overcapacity, oversupply within the market, and then you have to cut prices and dump inventory, and your margins suddenly contract. And if you look historically, if you just look at return on assets, for example, right now it's at about 10.87, but it went negative in 2021, which is expected. Well, even pre-COVID, but even pre-COVID, 2017, its return on assets went negative as well. So it can go through these periods. And I think he just missed the boat. Price of sales is at near an all-time high, or at 2.6. So one thing I like about it is a good balance sheet, very minimal debt with strong free cash flow. Like you said, buying back shares. But I just don't like the history of these names where there's just a lot of volatility to its earnings. And right now, it feels like peak earnings from especially when you look back in history.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates.
Hello, this is David in San Jose. Thank you for all you guys do. I had a question regarding the stock for my son, NVDA. Looking to invest in it and hold it for a long term. Wanted to know your thoughts and a good time to get in. Thank you.
All right. Well, NVIDIA, probably the most popular stock in the market today, historically.
Palantir has got to be more popular at this point.
You think so?
I don't know. There's some big Palantir lovers out there.
Well, I will say NVIDIA has a much better business than, at least existing business, than Palantir. But there's obviously a lot of hype around it, AI hype, a lot of investment in NVIDIA chips to build out AI infrastructure. And that's why earnings have gone from 33 cents in 2023 to $5.82 expected next year. That's a $167 stock. So even based on forward-looking earnings, Luke, you're still in mid to high 20s multiple, which isn't egregious, to be frank, as long as this growth continues. The question is, will the growth continue? Will the hyperscalers, the Amazons, Googles, Amazon, Google, who am I thinking? Meta, what's the fourth one? There's one, Microsoft, those four, those are the hyperscalers. They're spending a dramatic amount on CapEx. Obviously, a lot of that is going towards NVIDIA. And the question is, over time, can they keep a stranglehold on the AI chip market, or will companies like AMD, Intel, and others kind of edge into that and steal market share with comparable chips at maybe cheaper prices, et cetera, similar to what AMD did to Intel, a number of years ago? I think that's certainly a big risk that's out there. And this stock has certainly ran over the past few years. Like I said, it's trading at $167. Its recent low was around 86. So it's doubled basically from its April lows. So, I mean, how do you think somebody should look at NVIDIA from a long-term perspective at these prices?
Yeah, I mean, Everybody knows NVIDIA. It was the first $4 trillion company. It achieved that this month. Congratulations to that and everyone who's invested in it. The growth is undeniable, right? You're looking at 64.2% growth on an annualized basis going back to 2020. I think there's a lot of there's a lot of analogies drawn towards the dot-com bubble and companies like Cisco. I think you're in a different situation here. And NVIDIA is a hard product maker, right, with the chips. Whereas in the other situations, you're talking about a lot of software companies, which are far more replaceable than the hardware, right?
Well, Cisco is hardware, right? Or is hardware.
Oh yeah, that's correct.
Right.
Yeah, but I think that generally speaking, it's within the tech space, it is such a winner take all space that it is conceivable that a company that has held the dominant position within the GPU space could continue to do it in perpetuity. Now, the question is that going to happen? Is the downside risk right now higher than the upside risk? I think there is a lot of downside risk right now. That's not because I'm a perma bear on NVIDIA. It's just because they have been continuously hitting it out of the park. And the expectation is they continue to hit it out of the park. And at some point, CapEx does have to slow down, right? Businesses are cyclical. The economy is cyclical. At some point, as you saw earlier, right, when it was trading at around $80 in, when was that? That was in April, right after the tariff announcement, it slowly marched upward. You do see how volatile a name like this, which is pretty remarkable if you ask me, that a $4 trillion name can be this volatile. So there is just a lot of downside risk here, in my opinion.
Yeah, it's not just that other competitors might come and make similar or better products than NVIDIA, but it's also with history of the semiconductor space, which is very cyclical. Meaning you go into a recession, companies cut back, and it may not be just a recession. Like I said, the hyperscalers spending tens of billions of dollars per year on CapEx. All they have to do is step back a little and say, while AI is important and we're going to continue to build AI tools, the bigger question is, will AI drive actual positive business outcomes? Will there be an ROI on these tens of billions of dollars of investments for each of these companies? And as time goes on, it's going to be more than just $10 or $20 additional in monthly subscription revenue for a ChatGPT or something like that. It's going to need to be something that's more robust. I actually think that over time, and you see this back in the dot-com bubble, I think the analogy more is who benefited the most from the AI bubble from the tech bubble, tech bubble 1.0 in the late 90s. And was it those tech companies? Yeah, there were a few, like an Amazon, that really benefited dramatically. But there were the rest of the economy benefited far more, right? The efficiency of information and data, and they're the ones that really were allowed to or utilize that technology to its fullest. And the big question is once again, will those big hyperscalers, will they be able to monetize all this investment, or will AI just suddenly become a standard feature on every piece of software, right? Just like being in the cloud suddenly became the standard feature of software everywhere, starting in the late aughts. Okay, so that's where I think it's going. Is more, hey, the large language models are generally going to be for the use case for the vast majority of applications are going to be very fine, right? Whether you use a Perplexity or a ChatGPT or any of the other options that are out there for large language models, the basic use case for AI will be, for most people, will be similar. And so it won't really matter which one you use outside of specific cases. And that will make the economic viability of the models a lot more challenging. And I think that's the biggest risk to NVIDIA, is that those names step back, they say, we're not adding capacity at the same rate. And so I think and this is a volatile name. It does tend to fall. And I think it's a better time to buy this on a pullback when liquidity ebbs, probably sometime next year versus right now. Now let's head over and take another call. 2 in a row at 888-99-CHART.
Hey, Luke and Justin. This is Kevin from Southern California. I have a question regarding plans for kids. I have a 12 and 13-year-old, and I've already set up 529s for them. I've set up UTMAs for them, and I'm interested in setting up some Roth IRAs for them as well. And I know they're not old enough to get a lot of traditional jobs. Wondering if you had some thoughts about or some ideas for some jobs that they could have now so they can get some earned income and we can get those set up for them to plan for their long-term retirement goals already. Look forward to hearing your thoughts as always. Thanks again for having a great show.
All right, great question here. I like that you're already starting with 529s and other ways to save for your children. And a Roth IRA for kids is something that is a great idea. The problem is the child needs earned income. And so, if you have your own business, you can hire them. That's one way to do it. There's obviously there's labor age requirements. So it depends on how old your kids are.
It also depends what you're hiring them for, right? If you're hiring your 3-year-old to be a receptionist, certainly the IRS is going to come knocking and say, this is a very talented 3-year-old or you're lying to me. So, I think from what I've heard, a lot of people who want to do this for younger kids, try and get them some sort of brand ambassador, modeling, stock photography type of thing. Because again, it does have to be necessary, fairly compensated, age appropriate work. So you're right. It does depend what age you are. I kind of got the inclination that maybe it was a younger child from the way they were talking about it. But do keep in mind, for all of those of you who are listening, who are now thinking, I want to get my young child involved in the family business, the IRS will come knocking.
Yeah, exactly. It does need to be, like you said, age appropriate, and it needs to be reasonable for them to do. Right? Like you said, it's not reasonable for a 3-year-old to be a receptionist. But, I think there's flexibility in most businesses, right? Like you said, marketing, is it photography, things like that?
Yeah, for sure. If you had a local tool business, right? And you wanted to stage your baby holding the wrench, and that's your wrench ad, stuff like that. That seems perfectly reasonable to me. But certainly, as always, neither of us are tax experts.
Consult your CPA. Yeah. We use Kobe in some of our photography. You think
I can set up
Can I set up a Roth IRA for a dog? I've never seen that.
I don't know.
Probably not.
Probably not.
He doesn't have a social security number, so there you go. Discover more valuable information at investtalk.com. There's another question submitted from an online web forum, investtalk.com, and Pierre he says, Centene Corporation has already dropped quite a bit on high volume. Does the price per share now look attractive relative to the value? What do you think? Now, Centene is one of those names being caught up in the Medicare cuts and more scrutiny on Medicare expenses in general. And earnings are expected to fall dramatically from $7.17 last year to $4.95 next year, $3.05 this year. Now it's at $27.89. But obviously, analysts are kind of still searching for where the bottom is in earnings. Luke, do you think this is worth a gamble at these levels?
I don't know. Nobody really knows, and it's Medicaid cuts, I believe.
Is it Medicaid? Okay.
Medicare
Sorry
cuts, but I just want to get it out there. But I think nobody really knows the shape of the cuts, which is the problem, right? So with the big beautiful bill, which I swear I'm going to stop calling it that at some point, with the Trump bill, it pushed forward the continuation of the tax cuts and bonus depreciation for businesses to immediate, right, this year, or rather next year, I think, and then pushed out all of the Medicaid cuts until after the midterm election for political reasons, right? It's $1 trillion a year in Medicaid cuts. And so I think there's a lot of uncertainty of the way the shape of that is going to work out, because there is no one system that polices and creates Medicaid, right? Medicaid and Medicare is funding, or Medicaid is funding from the government towards the individual states. And so each state implements things within the law as required in order to receive that funding. And so everyone's kind of trying to figure out what the shape of the cuts are actually going to be, because it's going to vary from state to state. And I think that's where a lot of the uncertainty is for a company like Centene, but also companies within that industry.
Exactly. And that's the murkiness of their future business. And that's why everyone's kind of sold it willy-nilly. Now it is down extreme. I think it's a reasonable bet at this point because there's so much priced in. And the one reason why I say that is mainly because of the balance sheet. There's not a lot of long-term, or not a lot of debt. The debt to equity ratio is only 0.65. So I think, and they have a lot of short-term cash to offset their long-term debt. So I think that there's a lot of potential upside here. There's still potential downside for sure, but I think a lot of the bad news has been priced in. So it's still very, very high risk because of that lack of uncertainty, and you have to look at it such. If you can handle that high risk, then I think it's reasonable at these levels. Now, lastly, Luke, let's touch a bit on tariffs and how businesses are reacting to these tariffs. This is coming from Reuters. Looked at 279 different companies worldwide, from quarterly financial reports, interviews, statements from company officials, etc. And it's pretty interesting to see how they are reacting. What are you gleaning from the data that they reported?
Yeah, I think you saw a little bit of it in PPI. Not that PPI is measuring inflation or tariff impacts directly, right? Because it is producers' prices is domestic production. But a little look through showed you that the producers themselves had their costs higher, right? And that's exactly, you have the administration celebrating $100 billion in tariff revenue, but where does that revenue come from? Mm-hmm. It comes from consumers and it comes from businesses, and a little bit of it comes from the suppliers as well, right? There's not exactly a 100% split, cut somewhere, or 33, 33, 33. But it is obvious that businesses are being inundated with costs that they did not have last year. And that seems to be a problem for profitability.
Yeah, and if you look at the 279 companies, about 90-ish of them have increased prices. So it's about a third, roughly. And you had profit warnings from about a quarter, 66, let's see, it's 7, it's about close to 100 of them they've withdrawn or cut guidance completely. So you're seeing the impact here across the board. It's not the majority of companies that they're looking at they're reacting dramatically, but it's certainly they're all reacting in some way, shape, or form. Usually either price hikes, profit warnings, withdrawing guidance, supply chain changes, etc. So that's how most of these companies are reacting. Well, that about does it. I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. And if today's show made you think about your own financial picture in any way, maybe your investments, your taxes, your retirement planning, and whether your current path is really working for you, I encourage you to head over to investtalk.com and click on the portfolio review button, and you can schedule a call with myself or Luke to help bring clarity and confidence to the path that you are on. Now, we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And if you haven't already, head over to the new InvestTalkstore.com. Independent thinking, shared success. This is InvestTalk. Good night.